Trump is what I call a fiscal nincompoop. He doesn't pay any attention to the deficit, the debt levels. That kind of thing doesn't really interest him very much.
Today, I am pleased to welcome Steve Hanke to our podcast here at BeInCrypto. Mr. Hanke is a renowned professor of applied economics at Johns Hopkins University and a former advisor to the Reagan administration. It's so great to have you here today, Mr. Hanke.
Well, it's great to be with you, Camila.
I'm going to walk you through different topics currently affecting the American economy. Let's start with a recent report published by the Organization for Economic Cooperation and Development. Yesterday, the OECD forecasted a significant slowdown in U.S. GDP growth from 2.8% in 2024 to 1.5% in 2026. What do you think are the main contributing factors to these weakened economic prospects?
Well, I think the main thing probably the OECD is focused on is the election of Donald Trump and the fact that he's gone on kind of a shall we say, a tariff tantrum. And the prospect of imposing tariffs here, there, and everywhere is a big thing that causes economic growth to slow down. Because if you put a tariff on an international transaction, that's a tax, and international transactions are win-win situations. They're not a zero-sum game. The seller gains or they wouldn't be selling, and the buyer gains or they wouldn't be buying. And so you're imposing a tax on that transaction where the buyer and the seller are both winning. And what does the tax do? It rips part of that surplus out of the market and takes it and puts it in the government treasury. And as a result of that, you have fewer transactions. If you tax something, you get less of it, to make a long story short. So international trade will slow down, and that's one factor. Now, there's an additional factor related to that, and that's what I call regime uncertainty. And that is, there's so many things that the Trump administration are changing or threatening to change, and they are also changing their mind all the time. So not only they're changing a lot of things, but you don't know exactly the degree to which they're changing them, because they bob and weave back and forth, back and forth, back and forth. So that's what I term regime uncertainty. And when you have that, investors that are investing in, let's say, a new factory or something, they hunker down and they say, well, we're gonna wait and let the dust settle to see what's going to happen. And so they stop investing. And the last time we had this kind of regime uncertainty, this broad, changing the whole ball game, so to speak, was in the Great Depression in 1929, all through the 30s, basically. Franklin Delano Roosevelt was the president, and the New Dealers came in, and the New Dealers were a little bit like the MAGA Trumpers. They're changing everything. And as a result of that, you had a huge amount of this regime uncertainty with the New Deal and Franklin Delano Roosevelt. And as a result, the Great Depression was a lot deeper and lasted a lot longer than it would have otherwise lasted. And the reason for that is that investment basically stopped in the United States from 1929 until the start of World War II. That was all because of regime uncertainty. So that's the OECD's models and everything. I have another second thing that I think is more fundamental that the OECD and the central, like the Fed and the central banks, don't consider, and that's the quantity theory of money. It's all about the money supply. What was going on with the money supply a year ago, 2 years ago, and so forth, because that will impact what happens with the economy this year. And what we've had is a situation where the money supply is basically been stagnant since April of 2022. The stock of money measured by him too in the United States today is almost exactly where it was way back in April of 2022. Now, with that kind of stagnation in the growth of the money supply, you get a slowdown in the economy. It's like fuel for the economy. If you slow the fuel down going into an engine, the engine slows down. So that is something that has nothing to do with Trump. It happened a long time ago due to monetary policy. So with that, I anticipated with the money part and the stagnation in the money supply, I anticipated this year we would have a slowdown and probably a recession. Now we have this second element, which is the regime uncertainty associated with Trump, and that depresses things even further than would have been otherwise the case. So you kind of have a 1-2 punch going: weak monetary growth and the regime uncertainty, leading to, I think, what will end up being a recession in the United States. So I see a lower number than even the OECD or the IMF or any. All these institutions have revised things downward, Camila, because of the regime uncertainty aspect. But I factor in what really is underlying everything is the weak monetary growth. So I'm not surprised that they downgraded the growth rate.
And speaking of so much regime uncertainty going on, looking ahead to the third quarter of 2025, what's your view on the Federal Reserve's stance? Do you think that they will become more hawkish or less so?
Well, they're going to become less so because the economy is slowing down, and we had very weak labor market report today, for example, and the Federal Reserve keeps its eye on the labor market. That's a key thing. So as the economy slows down and the labor market gets weaker, the Fed will become more dovish. And you can see that if you look at the Chicago Mercantile Exchange, the federal funds futures market. That's the interest rate, of course, that the Fed controls, the federal funds. And they're looking, if you look out in September, a reduction of 150 basis points from where we're at now. There's a 14% probability of that. 125 basis point reduction, there's a 23% probability of that. 100 basis points, a full percentage points, that's about 26%. And a 75 basis point reduction, 19%. And a 50 basis point reduction, about 9% probability of that. So you can see by September, you get a range of, between 50 basis points and 150 basis points, a 0.5%, 1.5% reduction in the Fed funds rate is kind of baked in the cake. That's what the market thinks is going to happen. A lot of reduction in the Fed funds rate. So that's looser, not tighter. I think that the key thing, of course, and Trump, of course, is banging on Chairman Powell to reduce interest rates, these Fed funds rates. But that's a misguided thing, really, because monetary policy is not about changes in interest rates. It's about changes in the money supply. And what the Fed should be doing, it's still engaged in what they call quantitative tightening, shrinking its balance sheet and reducing the rate of increase in its contribution to the money supply. That's what quantitative tightening is doing. And what the Fed should do is drop quantitative tightening completely and increase the rate of growth in the money supply. The money supply is only growing now at 4.1% per year, and Hanke's golden growth rate for the growth rate in the money supply, consistent with hitting the Fed's inflation target of 2%, is about 6%. So they should be accelerating the growth rate in the money supply from where it is right now. And the best way to do that is to get rid of quantitative tightening. And we can see that because quantitative tightening, when it started, they were reducing the size of the balance sheet of the Fed at a certain rate. And then the quantitative tightening, they slowed the tightening down in June of 2024. Bingo, what happened? The money supply started growing at a little faster rate. It's still too slow, but if you want to get it growing at around 6%, you've got to get rid of quantitative tightening. And that's really what they should be focused on. The big problem is that the Fed does not pay attention to the growth rate in the money supply. They contend that the changes in the money supply don't have much of a connection between there's not much of a connection between changes in the money supply and changes in economic activity, which is false. And by the way, Matt Sukirky and I, May 6th, Wiley just released our new book, Making Money Work, and we emphasize the importance of the quantity theory of money and go into details. Kind of a new version of the quantity theory is contained in that book, and so that's hopefully that book will start influencing people in Washington and the Fed, so they again start looking at changes in the money supply and gear monetary policy appropriately.
Absolutely. And you actually touched on interest rates, which is such a big topic, and everyone's looking at the Federal Reserve in that respect. Market traders are forecasting 2 cuts by the end of 2025. Does that align with your expectations? Do you see a different number of cuts, no cuts?
No, I think there'll be more cuts. And the reason I say that, it's not me with a crystal ball telling you, Camilla, what I think is going to happen. I just look at the markets. The markets tell you what they think is going to happen. So that's the consensus you want to look at. That's the objective consensus of what people with skin in the game actually think is going to happen. And any way you cut it, it looks like there's going to be a 50 basis point, 0.5% to 1.5% reduction in the federal funds rate by the time we hit the September OMC meeting, or they decide on these things.
I also wanted to touch base on the US dollar index. Goldman Sachs recently suggested that the dollar is around 15% overvalued, with more room to actually fall. What's your outlook for the dollar index? Do you see its decline continuing in the third quarter?
That wouldn't surprise me, and let me tell you why. So what I think the fair value of the dollar euro rate, forget the index. The most important price in the world is the dollar euro exchange rate. So what I think the fair value of that is between 120 and 140. Today it's trading at 114. So what's that mean? That means that I agree with Goldman, that I think a fair value, if we went to 120, that's about a 6% depreciation in the value of the dollar. And if we went to 140, which is my top number for the fair value, that would be about a 24%. So 15 is about between 6 and 24. Those are the numbers. Basically, Goldman agrees with Hanke. Or if you want to put it the other way, Hanke agrees with Goldman. That 15% would put it kind of in a fair value. It's been extremely strong, the dollar, by the way, for the last 3 or 4 years. It's been out of that range. Right now, I say it's 114. Well, my upper end or lower end, if you will, is 120. So it's stronger than 120. Mm-hmm. So this wouldn't surprise me. And given events and the regime uncertainty and the rebalancing people are doing in their portfolios, moving a little away from an overweighted U.S. position to a kind of a normal, that's weakness. That engenders weakness in the U.S. dollar relative to the euro or the index, if you want to look at the index.
Absolutely. And this is something that we've spoken about recently, and I've written about for BeInCrypto. The U.S. bond market in the past 2 months has seen a surprising sell-off of bonds, which seems odd for a traditional safe haven. What do you think explains this contradiction?
Well, I think a lot of it is this regime uncertainty. That's what the bond market's pricing in. So what normally happens in a country like the United States, you're down there in Argentina. This isn't Argentina. This is the United States of America. So most emerging markets, this kind of thing happens, what we're seeing in the United States, but not in the United States, because in the United States, what normally happens is that you have kind of a two-step process that happens. If you tighten up the money supply, like I indicated we've been tight for over 2 years, what happens is that inflation comes down. The money supply is tight and inflation comes down, and it has come down in the United States. In April of 2022, when it started coming down, the money supply, the inflation rate was 8.3%. Now it's 2.3%. So money supply contracts, inflation contracts, and then what happens? Bond yields follow inflation normally in the United States or in most big capital markets. But that's not happening now. So we've got an unusual situation where the money supply is tight, inflation is coming down in the United States, but bond yields aren't coming down, they're going up. The 10-year bond yield, the key one to look at is, it's 4.5%, roughly. I haven't looked at it actually this morning, I confess, but it's more or less there. In any case, this is unusual. This is usually what you see in an emerging market, someplace like Argentina. You don't see it in the United States. So the question is why? And the answer is clearly the regime uncertainty that's being created by Trump. And part of that regime uncertainty, by the way, is the budget, because the budget, any way you want to cut it, Trump is what I call a fiscal nincompoop. He doesn't pay any attention to the deficit, the debt levels, that kind of thing doesn't really interest him very much. So what do we have? We have a budget that is working its way through Capitol Hill right now. It's been approved by the House. The Senate's looking it over. This big, beautiful bill, supposedly, that Trump's in love with, is carrying with it a huge deficit and debt load, and the markets are focusing on that. So that's part of the regime uncertainty. What is going to happen with the federal government's budget? That's part of what's going on. It's not only just the tariffs and all these other economic changes that are occurring.
Absolutely. And I'm so glad that you touched on the national deficit that the US has been chronically facing for several years. And I wanted to ask you, when discussing the fiscal discipline of the United States, who do you see primarily accountable for its enforcement? The president or Congress? I know you mentioned something about a constitutional amendment, and I'd love it if you could tell us more about it.
Okay, so the way it's been working, at least since basically the first Trump administration, this thing really started to get uncorked, and that is the deficit. So the deficit actually peaked out at about 3.1 trillion in 2020. That was the last year of Trump's first term, and then Biden, throughout his tenure, it was about 2 trillion. And now it's projected to go from 1.8 trillion to up to in 2034 it'd be up to 2.6 trillion. So it's very elevated levels. So that would suggest that neither the president or the Congress is in control of much of anything, given the way the rules are set up now. So I've been advocating, and I'm a member of the board of the Fiscal Sustainability Foundation, and we advocate having a constitutional convention under Article 5 of the Constitution, and I think we're moving in that direction. We do have 2/3 of the states that have requested this kind of thing, and the Congress will have to act on it. That is a constitutional convention, and what that would do is focus on this question of the deficit and the debt, and put in a constitutional rule, hopefully something like the Swiss debt break. And the Swiss voted in a referendum, almost 90% of the Swiss in 2001, to put in a Swiss debt break, change the Swiss constitution. And here's the way it works. They must balance the budget in Switzerland, and they can't allow government spending to grow any more rapidly than the real growth rate in the economy in Switzerland. So the government, the size of the government relative to the size of the economy will stay constant, or become less, but it can't become more. It can't kind of spread its wings and get larger. So at any rate, that is the only way I think you actually can control government spending and control a budget in the United States. Because if you try to do it with the statutory changes in the law, we've had that with like the Graham-Rudman bill, not decades ago, but that's the statutory changes and fixes are they're like a Band-Aid. They just tear off. They figure out a way around it. And that shows you that the incentives in the politics and so forth, you put some kind of constraint in the statute, and the politicians are, they're clever. They no. In a way, they're clever. They know how to get around their own laws and break their own laws, which they do. Which also suggests, to answer your question, that certainly the Congress isn't in control, because if they put a rule in to constrain themselves, they figure out a way how to break the rule, their own rule.
So what's the solution?
Well, you have to have a constitutional amendment. That's the only. You have to change the U.S. Constitution and do what the Swiss did. That's I think the only long run solution to this thing.
If you could give a few key pieces of advice to the government, you choose to who, whether it be Jerome Powell, President Trump, or members of Congress, what advice would you give them?
Well, if it's Powell, which is important because he's the chairman of the central bank, the Federal Reserve, that he should read Sakurki and Hanke, Making Money Work, very carefully and adopt a view consistent with the embrace of the quantity theory of money. Money matters. Basically, money matters, and that would be the first thing. Now they don't think money matters, so that's a huge thing. And I would also recommend that the president, the White House, and his economic team take a look at making money work, as well as the people on the Hill, not only the senators and Congress people, but also the staffs up there. So that's one big change. The other thing is that I do think that dusting off the playbook that we used with President Reagan would be a good thing, and that is supply side tax structure. Sound money we've already talked about, because Paul Volcker did embrace the quantity theory of money. He thought money mattered, so did President Reagan. So that's the money side, and then the tax side, supply side taxes, flat tax would be the best thing, where you have, for example, a rate of 13, 14, 15% on everybody, with no exemptions or no loopholes or anything like that. You just how much was your gross income? Put it on a postcard and multiply by the tax rate of whatever it is, 13%. And that number is your tax bill, and send that into the IRS every April, and that's the end of it. So that would be the tax side. Government spending, that's another element of Reagan. Control it, reduce the size of government relative to the size of the economy. And the last thing, free trade. So we're not doing much of that. They talk about a little deregulation. That's fine. The tax side, well, there is actually a good part of the only good part of this beautiful bill is the tax side, because it avoids increasing taxes. They keep advertising it as if it contains tax cuts. Well, it has some small tax cuts for not taxing tips, not taxing overtime pay, and not taxing Social Security benefits. But the rest of it is just no increase in taxes. the big part of it is that they're extending the tax cuts that were imposed in the first Trump administration. They're just saying we're not going to take those off. We're not going to increase taxes. And then, as I said, they've got a few little reductions, but that's more or less okay. But it's a long way from a flat tax, by the way. It remains, thousands of pages in the tax code, now all of this garbage, and the reason, by the way, why you don't want to increase taxes, that the taxes are very expensive to collect. People think the cost of government is just if I pay $1 in taxes, that's the cost, and that's not. It takes about 25 cents per dollar. A quarter of that is just administrative, me filling out my tax forms, hiring a tax lawyer, hiring an accountant, all this stuff. It's an expenditure, so it isn't free. So you have to add that 25 cents per dollar and another $2.75 you have to add for all the distortions that are caused by increasing taxes that slow the economy down. So to collect $1 in taxes, the actual cost, what we call a deadweight loss, is about $3. So that's why you want to contain government spending so you don't have to finance it either with tax increases, God forbid, or issuance of more bonds. So that's what I would do. Just dust off Reagan's old playbook and adapt it to today's circumstances, and you'd have a pretty good game plan. But we don't have Reagan's free trade thing. We don't have his government expenditure constraint and reduction. Both of those two big things are not in there. And three, the other thing that's not in there is what I mentioned about the quantity theory of money. So you have 3 out of the 5 that are missing in action.
Absolutely. You've been extremely generous for your time, so I'll close off with the following question. Considering such a turbulent macroeconomic environment, are investors increasingly moving towards traditional safe havens like gold, for example?
A little bit. Not as much as I think they should. I think they're kind of sleepwalking into what is going to be an economic recession and a bad news for the stock market. So the stock market in the United States is overhyped, overvalued, and overpriced, in my view. And I think it's in a bubble right now. My bubble detector, it's one of the highest readings on my bubble detector that I've had. The last time it was in this kind of zone was way back in the tech bubble in 2001. So the prudence is and a large cash position like Warren Buffett has is a good thing, not a bad thing. And being in things like gold is that's good, not bad. I've been bullish on gold for quite some time and remain bullish on gold, but you do at the edges you see a little bit of portfolio readjustment, as I mentioned earlier, happening. The foreigners were very overweighted in the U.S. stock market and bond market, and they're backing off and rebalancing a little bit, but those are not a run on the market or anything like that. It's just a little minor adjustments at the margin and rebalancing that are occurring. I think that people should be more cautious than they're being right now.
That's a strong note to end off on. Mr. Hanke, thank you so much for your time. It was so great having you here on our BeInCrypto podcast.
Well, great to be with you, Camilla.